Ever heard of getting paid to hold Bitcoin? Sounds crazy, right? Well, there's a new kind of ETF, a Bitcoin Covered Call ETF, that claims to do just that. But before you jump in, there's a lot to unpack. This video dives deep into the world of Bitcoin Covered Call ETFs. We'll crack the code on how they work, the potential benefits, and of course, the risks you need to consider. Is it a magic formula for Bitcoin profits? Tune in to find out. What is the underlying asset of a Bitcoin Covered Call ETF? A Bitcoin Covered Call ETF might seem straightforward from the name, but the underlying asset can be a bit surprising. Here's the breakdown. No direct Bitcoin ownership. Unlike a traditional Bitcoin ETF that directly holds Bitcoin, a covered call ETF does not. This means you don't have ownership of the actual Bitcoin itself. Two possibilities for underlying asset. There are actually two main structures for Bitcoin Covered Call ETFs. 1. Bitcoin Futures ETF. This is the more common structure. The ETF holds shares of another ETF, typically a Bitcoin Futures ETF. These futures ETFs track the price of Bitcoin by using Bitcoin futures contracts. So, indirectly, the ETF is exposed to Bitcoin price movements through the futures contracts. 2. Synthetic Bitcoin exposure. A less common approach involves using options contracts to achieve a synthetic exposure to Bitcoin. The ETF holds other assets, but uses option strategies to mimic the price movements of Bitcoin. Why not direct Bitcoin? There are a couple of reasons why a Bitcoin Covered Call ETF wouldn't hold Bitcoin directly. Regulatory restrictions. Some regulatory environments might restrict ETFs from holding certain assets like Bitcoin. Futures contracts or options can offer a way to gain exposure while potentially navigating these restrictions. Efficiency. Using futures or options contracts can be a more efficient way for the ETF to manage its holdings and implement the covered call strategy. How does the covered call strategy work within a Bitcoin ETF? The covered call strategy is a cornerstone of a Bitcoin Covered Call ETF. It allows the ETF to generate income while also limiting potential upside gains from Bitcoin's price appreciation. Here's a breakdown of how it works within the context of a Bitcoin ETF. The mechanics. 1. Underlying asset held. As discussed earlier, the ETF holds shares of a Bitcoin futures ETF, most common, or uses options to achieve synthetic Bitcoin exposure. 2. Selling call options. The ETF sells call options on the underlying asset, Bitcoin futures or synthetic exposure. These call options grant the buyer the right, but not the obligation, to purchase the underlying asset at a specific price, strike price, by a certain date, expiry date. 3. Premium collection. In return for selling the call options, the ETF receives a premium upfront. This premium represents the income generated by the strategy. Capping gains, boosting income. Limited upside. If the price of Bitcoin rises above the strike price of the sold call options by the expiry date, the call option holder will likely exercise their right to buy the underlying asset from the ETF at the lower strike price. This limits the ETF's gains from significant Bitcoin price appreciation. Consistent income. Regardless of Bitcoin's price movement, the ETF keeps the premium collected from selling the call options. This provides a consistent stream of income for investors. Matching options and holdings. Matching strike prices. The strike price of the call options sold by the ETF is typically chosen to be close to the current price of the underlying asset, Bitcoin futures or synthetic exposure. This helps balance the potential for income generation with the risk of capped gains. Rolling options. As the expiry date approaches, the ETF may choose to roll the options contracts. This involves closing out the existing options and selling new ones with a further out expiry date. This allows the ETF to continue collecting premiums and potentially adjust the strike price based on market conditions. What are the benefits of investing in a Bitcoin Covered Call ETF? Bitcoin Covered Call ETFs offer a unique approach to cryptocurrency investing, presenting several potential benefits for investors seeking income and a more balanced exposure to Bitcoin. Here's a closer look. 1. Income generation. Consistent stream. The core benefit of a covered call ETF is the generation of income through option premiums. By selling call options, the ETF receives a premium upfront, regardless of Bitcoin's price movement in the short term. This provides a consistent income stream for investors, which can be particularly attractive in a volatile market like Bitcoin. 2. Reduced volatility. Hedging mechanism. The covered call strategy acts as a built-in hedge against significant price drops in Bitcoin. While it limits potential gains, it also helps to cushion the blow of sharp price declines. This can be appealing to investors who want some protection from Bitcoin's inherent volatility. 3. Diversification. Income alternative. For investors seeking exposure to Bitcoin but also looking for income generation, a covered call ETF can offer a valuable diversification tool. It allows you to participate in the potential growth of Bitcoin while also generating income that can be used to offset potential losses or be reinvested elsewhere. 4. Potentially lower fees. Management efficiency. Compared to actively managed Bitcoin funds, covered call ETFs might have lower expense ratios. This is because the covered call strategy is a relatively defined approach, potentially requiring less active management from the fund managers. 5. Accessibility. ETF structure. Covered call ETFs offer a convenient and accessible way to implement the covered call strategy. Unlike individually implementing the strategy yourself, which requires a brokerage account and knowledge of options, ETFs provide a readily available product for investors of all experience levels. What are the risks associated with a Bitcoin Covered Call ETF? While Bitcoin Covered Call ETFs offer potential benefits like income generation and reduced volatility, there are also inherent risks to consider before investing. Here's a breakdown of some key drawbacks. 1. Capped upside potential. Missed out gains. The biggest risk is the capped potential for gains. By selling call options, you forfeit the chance to benefit fully if the price of Bitcoin surges significantly above the strike price of the options sold. This can be a major drawback if you're bullish on Bitcoin's long-term price potential. 2. Lower overall returns. Income versus growth. While covered calls generate income, they typically underperform compared to directly holding Bitcoin during strong uptrends. The income received from premiums may not fully compensate for the missed opportunity for higher capital appreciation. 3. Complexity and fees. Underlying asset risk. Remember, the ETF might not hold actual Bitcoin, but rather Bitcoin futures or synthetic exposure. These instruments have their own set of risks, such as tracking error or potential counterparty risk in the case of futures contracts. Option strategy management. While seemingly straightforward, managing the covered call strategy requires careful consideration of strike prices, expiry dates, and rolling options. This complexity can translate into higher fees associated with the ETF management. 4. Limited liquidity. Newer product. Bitcoin Covered Call ETFs are a relatively new product category. This means they might have lower trading volumes compared to established Bitcoin ETFs. Lower liquidity can lead to wider bid-ask spreads and potentially impact your ability to enter or exit positions quickly. 5. Tax implications. Option premiums. The income generated from option premiums in a covered call ETF may be taxed differently than capital gains from directly holding Bitcoin. Depending on your tax jurisdiction, this could have implications for your overall return. Who should beware? These risks make Bitcoin covered call ETFs less suitable for investors who strongly believe in Bitcoin's long-term growth. If you're convinced Bitcoin's price will appreciate significantly, the capped upside of a covered call ETF might not be ideal. Seek high returns. Investors looking for maximum potential returns from Bitcoin might be better off with a traditional Bitcoin ETF. How do option strike prices and expiry dates impact a Bitcoin covered call ETF? The strike price and expiry date of the call options sold in a Bitcoin covered call ETF are crucial factors that significantly impact the ETF's performance and risk profile. Here's a detailed breakdown of their influence. Strike price. Income versus upside potential. The strike price you choose for the sold call options directly affects the trade-off between income generation and potential upside gains. Higher strike price. Selling call options with a higher strike price, further out of the money, generates a lower premium upfront but allows the ETF to benefit more if Bitcoin's price rises significantly above the strike price by expiry. Lower strike price. Selling call options with a lower strike price, closer to at the money, generates a higher premium upfront but limits the potential gains from Bitcoin's price appreciation. The call option is more likely to be exercised if the price goes up, capping the ETF's upside. Balancing risk and reward. The optimal strike price depends on your risk tolerance and market outlook. A more conservative approach might involve choosing a higher strike price to prioritize income generation and some downside protection. Conversely, a more bullish view on Bitcoin might lead to selecting a lower strike price to capture a larger potential upside, even with a lower premium. Expiry date. Time value and income. The expiry date of the call options sold also influences the premium received. Options with a longer time to expiry, further out, typically have a higher premium compared to options with a shorter time to expiry, closer to expiration. This is due to the time value component of option pricing. Rolling options and strategy management. Since Bitcoin covered call ETFs aim for consistent income generation, they often employ a strategy called rolling options. As the expiry date of the initially sold options approaches, the ETF manager might close out those options and sell new ones with a further out expiry date. This allows the ETF to continue receiving premiums and potentially adjust the strike price based on the current market conditions. Impact on volatility. The frequency of rolling options can also impact the overall volatility of the ETF. More frequent rolling, shorter expiry dates, can lead to a more actively managed approach, potentially offering some control over the income stream but potentially increasing management fees. Conversely, rolling options with longer expiry dates can result in a more passive approach with potentially lower volatility but also potentially lower income generation in a fast-moving market. What is the typical percentage of Bitcoin held in a covered call ETF? Here's the key point to remember about Bitcoin covered call ETFs. They don't directly hold Bitcoin. Instead, they use one of two main approaches to achieve indirect exposure to Bitcoin's price movements. 1. Bitcoin futures ETFs. This is the more common structure. The ETF holds shares of another ETF, typically a Bitcoin futures ETF. These futures ETFs track the price of Bitcoin by using Bitcoin futures contracts. So, there's no ownership of actual Bitcoin itself. 2. Synthetic Bitcoin exposure. A less common approach involves using options contracts to achieve a synthetic exposure to Bitcoin. The ETF holds other assets, but uses option strategies to mimic the price movements of Bitcoin. Again, no direct Bitcoin ownership. Therefore, the concept of a typical percentage of Bitcoin held doesn't directly apply to covered call ETFs. They don't hold any Bitcoin themselves. However, here's some additional information that might be helpful. Exposure through underlying asset. The percentage of Bitcoin exposure in a covered call ETF depends on the underlying asset it utilizes. Bitcoin futures ETFs. These typically aim to track the price of Bitcoin as closely as possible through their futures contracts. So, in essence, they offer close to 100% exposure to Bitcoin's price movements, although with some potential tracking error due to the nature of futures contracts. Synthetic Bitcoin exposure. This approach might involve using a combination of options contracts with varying degrees of delta, a measure of an option's price sensitivity to the underlying asset. The specific percentage of Bitcoin exposure achieved through this method would depend on the chosen option strategy. How do Bitcoin Covered Call ETFs generate income? Bitcoin Covered Call ETFs generate income through a strategy called selling covered calls on the underlying asset that provides exposure to Bitcoin's price movements. Here's a breakdown of how it works. The mechanics. 1. Underlying asset held. Remember, the ETF doesn't hold Bitcoin itself. It holds shares of a Bitcoin futures ETF, most common, or uses options to achieve synthetic Bitcoin exposure. These assets track Bitcoin's price movement indirectly. 2. Selling call options. The ETF sells call options on the underlying asset, Bitcoin futures or synthetic exposure. These call options grant the buyer the right, but not the obligation, to purchase the underlying asset at a predetermined price, strike price, by a specific date, expiry date. 3. Premium collection. In return for selling the call options, the ETF receives a premium upfront. This premium represents the income generated by the strategy. Understanding the income stream. Independent of price movement. The key point to remember is that the ETF keeps the premium regardless of whether the price of Bitcoin goes up or down in the short term. This provides a consistent stream of income for investors in the ETF. Trade-off between income and gains. There's a crucial trade-off here. While the ETF gains income from the premiums, it also limits its potential for significant capital appreciation from Bitcoin's price increases. How does the volatility of Bitcoin affect the returns of a covered call ETF? The volatility of Bitcoin has a complex impact on the returns of a Bitcoin covered call ETF. Here's a breakdown of the interplay between these factors. Impact on income. Higher volatility, potentially higher income. In a volatile market with frequent price swings, Bitcoin covered call ETFs have the potential to generate higher income from selling call options. This is because options premiums are generally more expensive, higher, when the underlying asset, Bitcoin exposure, is more volatile. Rolling options and strategic adjustments. Covered call ETFs often employ a strategy called rolling options. As the expiry date of the initially sold options approaches, the ETF manager might close out those options and sell new ones with a further out expiry date. In a volatile market, these rolling strategies can be used to capture higher premiums as volatility increases. Impact on capital appreciation. Tapped upside. The biggest impact of Bitcoin volatility on a covered call ETF is the capped upside potential. Remember, the ETF sells call options with a specific strike price. If Bitcoin's price surges significantly above the strike price by expiry, the call option holders will likely exercise their right to buy the underlying asset at the lower strike price. This limits the ETF's gains from the significant price increase. Missed out opportunities. In a highly bullish market with a strong upward trend for Bitcoin, a covered call ETF might miss out on substantial capital appreciation opportunities due to the capped upside from the sold call options. Finding the balance. Strike price selection. The selection of the strike price for the call options sold plays a crucial role in managing this trade-off. A higher strike price offers more protection against downside volatility, but also limits potential gains from significant upswings. Conversely, a lower strike price captures more upside potential, but exposes the ETF to more downside risk. Overall returns. Volatility can cut both ways. while volatility can lead to higher option premiums and income generation for the ETF, it can also limit the potential for capital appreciation from significant Bitcoin price increases. This can result in lower overall returns for the ETF compared to directly holding Bitcoin during strong uptrends. How do Bitcoin Covered Call ETFs compare to traditional Bitcoin ETFs? Bitcoin Covered Call ETFs and traditional Bitcoin ETFs offer distinct approaches to investing in the cryptocurrency. Here's a breakdown of their key differences to help you decide which might be a better fit for your investment goals. Investment objective. Traditional Bitcoin ETFs, these aim to track the price of Bitcoin as closely as possible. They typically hold Bitcoin directly or invest in Bitcoin futures contracts, offering investors direct exposure to Bitcoin's price movements. The goal is to capture potential capital appreciation from Bitcoin's price increases. Bitcoin Covered Call ETFs, these prioritize income generation over maximizing capital appreciation. They don't hold Bitcoin directly but use option strategies on the underlying asset, Bitcoin futures or synthetic exposure, to generate income through option premiums. The capped upside potential helps to mitigate some downside risk from Bitcoin's volatility. Risk and reward. Traditional Bitcoin ETFs offer potentially higher returns by capturing significant price increases. However, they also expose investors to the full brunt of Bitcoin's volatility, which can lead to substantial losses during price downturns. Bitcoin Covered Call ETFs provide a more conservative approach with a consistent stream of income from option premiums. This helps to offset some of the volatility but limits the potential for significant gains if Bitcoin's price skyrockets. Suitability. Traditional Bitcoin ETFs, ideal for investors with a strong bullish outlook on Bitcoin's long-term price potential and a high tolerance for risk. Bitcoin Covered Call ETFs, more suitable for investors seeking income generation and a more balanced exposure to Bitcoin. This might be appropriate for investors who want some participation in Bitcoin's potential growth, but also want to mitigate some of the volatility. Are Bitcoin Covered Call ETFs suitable for all investors? No, Bitcoin Covered Call ETFs are not suitable for all investors. Here's a breakdown of the investor profiles that might find them more or less appealing. Good fit for income seekers. Investors prioritizing consistent income generation can benefit from the regular stream of option premiums offered by covered call ETFs. This can be particularly attractive in a volatile market like Bitcoin, where price swings might make capital appreciation less predictable. Risk-averse investors. The capped upside of covered call ETFs can provide some protection against significant price drops in Bitcoin. This can be appealing to investors with a lower risk tolerance who still want some exposure to Bitcoin's potential growth. Balanced portfolio investors. Covered call ETFs can offer a way to diversify a portfolio and add a layer of income generation while still participating, to a limited extent, in Bitcoin's potential price appreciation. Less suitable for strong Bitcoin believers. If you have a strong conviction that Bitcoin's price will surge significantly in the long term, the capped upside potential of covered call ETFs might be a major drawback. You might be better off with a traditional Bitcoin ETF that offers the chance to capture the full upside potential. Growth-oriented investors. Investors primarily focused on maximizing capital appreciation might find the income generation of covered call ETFs insufficient compared to the potential for much higher returns from directly holding Bitcoin during strong uptrends. Short-term traders. Covered call ETFs are not ideal for short-term trading strategies due to the option expiry dates and the potential need for rolling options. These strategies are better suited for a longer-term investment horizon. What are some of the limitations of using a covered call strategy with Bitcoin? The covered call strategy, while offering income generation and some risk mitigation, has limitations when applied to Bitcoin. Here's a breakdown of some key drawbacks to consider. Capped upside potential. Missed out gains. The biggest limitation is the capped potential for capital appreciation. By selling call options, you forfeit the chance to benefit fully if the price of Bitcoin surges significantly above the strike price of the options sold. This can be a major drawback, especially if you're bullish on Bitcoin's long-term price potential. Lower overall returns. While covered calls generate income, they typically underperform compared to directly holding Bitcoin during strong uptrends. The income received from premiums may not fully compensate for the missed opportunity for higher capital appreciation. Management complexity. Underlying asset risk. Bitcoin Covered Call ETFs don't hold actual Bitcoin, but rather Bitcoin futures or synthetic exposure. These instruments have their own set of risks, such as tracking error or potential counterparty risk in the case of futures contracts. Option strategy management. Managing the covered call strategy requires careful consideration of strike prices, expiry dates, and rolling options. This complexity can translate into higher fees associated with the ETF management. Limited flexibility. Early exercise risk. The option buyer has the right to exercise the call option early if the price of Bitcoin goes above the strike price. This can force the ETF to sell its underlying Bitcoin exposure, via futures or options, even if you believe the price might continue to rise. Less control over exposure. Compared to directly holding Bitcoin, covered call ETFs offer less control over your exposure. The underlying asset selection, futures or synthetic, and the chosen option strike prices can limit your ability to tailor the investment to your specific risk tolerance and market outlook. Additional considerations. Tax implications. The income generated from option premiums in a covered call ETF may be taxed differently than capital gains from directly holding Bitcoin. Depending on your tax jurisdiction, this could have implications for your overall return. Newer product. Bitcoin Covered Call ETFs are a relatively new product category. This means they might have lower trading volumes compared to established Bitcoin ETFs. Lower liquidity can lead to wider bid-ask spreads and potentially impact your ability to enter or exit positions quickly. How do Bitcoin Covered Call ETFs compare to other income-generating crypto investments? Bitcoin Covered Call ETFs offer a unique approach to generating income from cryptocurrencies, but they're not the only option. Here's a breakdown of how they compare to other income-generating crypto investments, helping you choose the best fit for your goals. 1. Staking. Concept. Staking involves locking up your cryptocurrency holdings for a specific period to support the network's operations, e.g., proof-of-stake blockchains. In return, you earn rewards or interest on your holdings. Comparison to covered call ETFs. Income potential. Staking rewards can vary significantly depending on the chosen cryptocurrency and its staking mechanism. Some offer higher potential returns compared to the option premiums from covered call ETFs. Risk profile. Staking generally carries lower risk than covered call ETFs. You retain ownership of the underlying cryptocurrency, and there's no capped upside potential. However, the value of the staked cryptocurrency can still fluctuate, leading to potential losses. Accessibility. Staking might not be readily available on all cryptocurrency exchanges or for all cryptocurrencies. Covered call ETFs offer a more convenient way to access income generation. 2. Lending platforms. Concept. Crypto lending platforms allow you to lend your cryptocurrency holdings to others in exchange for interest. This can be a good way to earn passive income from your crypto assets. Comparison to covered call ETFs. Income potential. Similar to staking, interest rates on lending platforms can vary depending on the borrowed cryptocurrency and loan terms. They can potentially offer higher returns than covered call ETFs. Risk profile. crypto lending platforms introduce counterparty risk. If the borrower defaults on the loan, you might lose your crypto assets. This risk is generally not present with covered call ETFs. Management: lending platforms might require more active management compared to covered call ETFs, where the ETF manager handles the options strategy. 3. DeFi, decentralized finance, yield farming. Concept: yield farming involves depositing your crypto assets into DeFi protocols to earn rewards or interest. These protocols can be complex and carry significant risks. Comparison to covered call ETFs. Income potential: DeFi yield farming can offer potentially very high returns, but these are often accompanied by high risks and complexity. Covered call ETFs provide a more controlled and transparent approach to income generation. Risk profile: DeFi yield farming carries significant risks of impermanent loss, where the value of your deposited crypto assets fluctuates relative to the reward token, and smart contract vulnerabilities. Covered call ETFs are generally considered less risky. Accessibility: DeFi can be complex and requires a good understanding of the underlying protocols and potential risks. Covered call ETFs offer a more accessible option for most investors. Choosing the right option. The best income-generating crypto investment for you depends on your risk tolerance, investment goals, and desired level of control. Here's a quick summary. For highest potential returns, with highest risk, DeFi yield farming. For high potential returns, with moderate risk, staking or lending platforms. For consistent income and lower risk, Bitcoin covered call ETFs. Alright, there you have it. A deep dive into the world of Bitcoin covered call ETFs. We explored how they work, the potential benefits and risks, and how they stack up against other income-generating crypto options. So, are Bitcoin covered call ETFs right for you? It depends on your goals. If you prioritize income generation and some protection from Bitcoin's volatility, they could be a valuable tool. But if you're a die-hard Bitcoin believer looking for maximum potential gains, a traditional Bitcoin ETF might be a better fit. Remember, do your own research before investing in any cryptocurrency product. Thanks for watching. Don't forget to like and subscribe for more crypto content. In the comments below, let us know what you think about Bitcoin covered call ETFs. Are they a game changer or just a gimmick? We'd love to hear your thoughts.